Welcome, everyone. Thank you all for joining today's Leading Through Crisis program, The Effects of COVID-19 on Real Estate Markets. My name is Kristen Svenningsson, and I'm the Managing Director of the Paul Milstein Center for Real Estate at Columbia Business School. It is my pleasure to introduce today's presentation and our speaker. Tomasz Piskorski is the Edward S. Gordon Professor of Real Estate in the Finance Division at Columbia Business School. He is a research associate at the National Bureau of Economic Research, and he serves on the Academic Research Council for the Housing Finance Policy Center at the Urban Institute. Professor Piskorski's research explores issues in real estate finance, securities and mortgage markets, financial intermediation and banking, market structure and regulation, and housing policy. His recent work centers on inefficiencies in credit markets, financial technology, shadow banking, financial regulation, mortgage market reform, and the impact of consumer credit markets on the broader economy. His research has been published in top academic journals, as well as featured in major media, including the Wall Street Journal, the Financial Times, Bloomberg, Business Week, and The Economist. At Columbia, Professor Piskorski teaches courses on real estate finance, big data in finance, and executive ethics. He's most recently developed and taught a course on prop tech and disruption, and has co-directed the executive education program on real estate investing. Thank you, Professor Piskorski, for being here today, and I will turn the presentation over to you. And also just remind everyone that if you have questions throughout the presentation today, to please submit them through the Q&A channel at the bottom of your screen.
Welcome, everybody. And Kristen, thank you very much for the introduction. So let's just get going. Let me give you a little bit of an outline of what I would like to talk today. First of all, if you think about impact of COVID-19 on real estate markets, there are really two critical factors that play a role here. One is evolution and persistence of the pandemic itself, and I'm not going to talk much about that. You know, this is not my specialty. I have exposure to medical profession partly through my family, so there are all kind of views out there. And we don't really have a great data for that. Like if you think about Spanish flu, for example, it has been a very different pandemic in a very different economy. So as a result of that, it's a big factor that is really generating significant uncertainty going forward. What I will emphasize, though, the second factor that critically impacts the severity of the pandemic and its impact on the economy, including real estate markets, is the nature of the policy response. So I'll emphasize that when you try to predict, what's going to happen to economy and real estate markets in particular, you really also take a stand on what's going to happen to policy response. So in the very first few minutes of my talk, I'm going to spend some time on Great Recession and lessons from the Great Recession. And I will try to make a point that these lessons very importantly inform the current policy response. In some sense, if you think about the response to Great Recession, what it did, it helps you predict what administration and Congress is likely to do going forward, and you can draw some sort of implication from that. Once I do that, once I briefly talk about Great Recession, I will tell you what was the policy response to COVID-19, emphasizing also the elements that affect real estate capital markets and how sort of it differs and compares to the policy response to Great Recession. Then I'm going to spend time on discussing the impact of COVID-19 on residential real estate, both housing and mortgage markets. Then we're going to move to the impact on commercial real estate, and then I will conclude with some broader thoughts and speculations on long-term impact of COVID-19. So first, let me talk briefly, spend a few minutes on Great Recession. This is the last crisis we had. It started roughly around 2007. We know we have millions of foreclosures. We have a very significant loss of output, and there has been a very significant set of stimulus measures implemented during the Great Recession to help stimulate the economy and real estate markets, especially housing market in particular. Just to show you what happened during Great Recession, we have a very big drop, similar to the drop that happened in March, in early April during COVID-19, during the initial stage of the COVID-19 pandemic in the US, and there was subsequent recovery. One thing I want to emphasize, if you look on the recovery from Great Recession, it took quite some time. Just looking on the stock prices, took about 5 years for S&P 500 to really recover to the pre-crisis, pre-Great Recession level. And in response to Great Recession, we had a string of various stimulus measures implemented. I want to emphasize two things. First, the various rounds of quantitative easing. What you see on this picture is decline in interest rates to a very low level. And also you had a specific programs aimed at stimulating real estate markets, especially the housing market, home affordable modification program, when government paid services to modify loans, and home affordable refinancing program, when essentially it was allowed for people with very little housing equity to refinance their debts to take advantage of these low rates. And one thing I want to stress is these measures were not implemented immediately. And in fact, there was some policy delay in making them work. So for example, initially home affordable financing program, which was implemented in March 2009, was really only applicable to people with loan to value ratios less than 125%. So if you really suffer a big collapse of house prices, you couldn't take advantage of that. And it took Congress and administration about 3 years to fix it. So you can see a very significant policy delay. And one nature of Great Recession, and this is why we worry about COVID-19 pandemic, is the recovery from the Great Recession was really, really slow. So for example, the mortgage default, it took almost 4 years for the mortgage default to get back to normal. And in fact, only 74% regions recovered. If you look, for example, on house prices, by 2017, house prices recovered only in about half of the US zip codes. And it took those zip codes that recovered took about 5 years to get there. Same about the recovery of consumption here measured by auto purchases, and same about recovery of employment. So one thing I want you to remember, similar to what we see in the recovery of S&P 500, the recovery from Great Recession took many years. And that's why, if you think about COVID-19, there's an obvious concern that we have initial shock, but it might take a lot of time to get back to normal. This just, for example, shows you that the red areas are areas that haven't recovered consumption from Great Recession by 2016. So we see also recovery was very uneven. And, just to kind of sum up the effects of Great Recession, we have about 10% of households with debt lost homes. So we have foreclosures in the order of 6 million. And there are significant costs of foreclosures. Most borrowers that lost homes to foreclosure have to move to another areas. Only about a quarter of borrowers regained home ownership, taking about 4 years on average to do so. Of course, foreclosures are also associated with a very significant decline in borrower credit worthiness that can affect the ability to, obtain new credit, to spend. And more fundamentally, we worry about crises. And in particular, if you think about COVID-19, the initial worry was if we end up repeating Great Recession and we end up repeating wave of foreclosures have significant deadweight costs. Just to give you an example, the home in the middle went into foreclosure in 2009. This is when the lender repossessed in 2012. So this kind of working out through the debt crisis and economic recession through foreclosure can have very significant costs. So why recovery from Great Recession was so slow despite these various stimulus measures? And it's important to think about it because this kind of a lesson from Great Recession, I think really importantly informed what the Congress and administration is doing nowadays. So first of all, when during Great Recession Fed lower rates, only a few borrowers benefited directly because most contracts in the US are fixed rate mortgages. Only folks with ARMs get immediate debt relief. Now, of course, another way to take advantage of low rates like we have right now during COVID-19 pandemic is to refinance your loans, but it was hard to do it because of various refinancing constraints. If you have negative equity or lost job, it was hard to refinance. Home affordable refinancing program partly alleviated it, but it was not really as successful because of various delays in fixing it. Let me make a point that this program was championed by Glenn Hubbard and Chris Mayer from Columbia, so I view them as one of the founding fathers of this policy that helped about 3 million households regain, essentially lower the cost of their debt. In addition, banks didn't have limited incentives to work out loans they didn't own. And again, home affordable modification program partly alleviated it. But also a lot of financial institutions didn't really have capacity to offer help and relief to households because of various institutional frictions. And a simple assessment is that these frictions accounted for about 50% of crisis, more than 50% of crisis severity. In other words, if you look at Great Recession, and even taking the initial shock as given, the type of risky debt that was there, the crisis will be about 50%, at least 50% less severe if the policy response was better in this. And of course, another thing is the areas that get more help, more debt relief, more liquidity support recover much faster. This picture just shows you the change in the growth of auto consumption. It's a measure of durable spending. And you can see that areas that get more debt relief, quicker path from lower interest rates, recover faster than areas that did not. And I want to stress these effects were very persistent. So the last slide on Great Recession, kind of the bottom line lesson from this is importance of temporary household liquidity support and debt relief for recovery. There are really two broad ways to implement it. We already have unemployment insurance that plays some of this role. Alternatively, we could consider some sort of state contingencies build up in providing household debt relief during crisis. In addition, you can use this ex post stabilization programs like HARP and HAMP, or the CARES Act that was passed in response to pandemic. The issue is that one thing you have to keep in mind, you really cannot really fully rely on private sector for implementation of these policies. And of course, you need to think about what kind of frictions you try to solve. Usually we think about dead weight cost of foreclosures. There could be some demand externalities. There could be some marketing completeness. You have to take into account the impact of these policies on incentives to repay debt, to find work, and the broader consequences, think about fiscal stability, long-term impact on inflation, and so on. So let me now move to the COVID-19 and policy response. The one thing I want to emphasize first, that the policy response to COVID-19 was really very aggressive. It's like what was done in Great Recession, but on steroids. So I think this lesson that we have to act quickly and decisively, and in some sense we have to avoid some, working for private sector has been kind of learned and implemented. So just to show you the timeline of response to COVID-19, we have national emergency declared by President Trump on March 13. Very quickly, Fed steps in. Within literally 2 days, you have slashing rates to virtually zero, the launch of another round of quantitative easing, and a very important policy, CARES Act, signed by President Trump in March 27. I'm going to talk about it because it importantly affects what's happening in the real estate markets. And then, some provisions of this program recently expired. There is currently a bit of a gridlock in Congress negotiation, of course, affected by the coming election. So President Trump issued recently this executive order trying to prolong some of the stimulus measures implemented in CARES Act. So CARES Act is a multi-trillion program. And one thing I want to emphasize in terms of its impact on real estate markets is a bunch of things. So first of all, you have significant financial assistance to businesses. You have this $500 billion lending program to firms. You have paycheck protection program that helps essentially small businesses employ their workers. But a very important element of CARES Act is a very generous unemployment benefit support. In addition to regular unemployment benefits, an unemployed working candidate can get $600 per week until, of course, it expired in July 2020, by the end of July, just a few days ago. So just to give you a sense, the $600, a recent study from JP Morgan Chase found out that more than 70% unemployed were actually making more money while being unemployed than in their prior jobs. So why this is important? Of course, such level of stimulus in some sense avoids an immediate impact or limits immediate impact on real estate. Think about paying mortgages. If 70% of unemployed actually can effectively make more money than before, they're not necessarily going to start missing in mass payments on their mortgages and so on. And in addition, this program has really a lot of measures that were meant to help with, preventing foreclosures. In particular, if you have government-backed mortgage, it's about 2/3 of the total. There was a suspension of foreclosure actions on these loans. And moreover, you can get up to a year's worth of mortgage forbearance. If you are a renter in a multifamily property that's financed, for example, with GSE-backed loans, there was essentially 120 days eviction on moratorium on evictions for renters. And these policies were reinforced with additional state and local moratoria. So one thing I just want to emphasize, a lot of initial effects of COVID-19 are kind of not as strong as we would expect because of this extremely aggressive policy response. And what we want to, if we think about predicting the longer term impact on real estate markets, we really would have to think about how the policy will evolve going forward. So this is just what Fed also did. Fed added $2 trillion of liquidity in a matter of literally 5 weeks. And that essentially, in addition to market developments, resulted in significant decline in long-term rates. So the Treasury right now, 10-year Treasury is around 60 basis points, which is really very, very low level by historical standards. So let me start first talking about the impact of COVID-19 on housing finance market. And I'll start by showing you some simulations we did on the impact on the residential mortgage market. We did these simulations early on, just when COVID pandemic was starting. Just to give you a bit of sense how big the residential mortgage market is, we have about $11 trillion of this debt outstanding. Why it's big, it's smaller as a proportion of GDP than during the Great Recession. So in 2007, that's about $11 trillion was more than 70% GDP. Now it's about a half. So in that sense, the residential debt become less important part of economy in proportion to the economic activity, but it's still very, very important. So what we did first, with my colleagues, we did some simulations on what's going to happen to the residential real estate market, especially residential lending market, in response to the COVID-19. So we big unknown in doing these projections is what's going to happen to house prices. Just to give you a sense, the leading companies are somewhat split. Zillow is more optimistic. They predict about 2 to 3% decline. CoreLogic in some predictions goes to 6 to 7% decline. Obviously, the impact of unemployment is very different than in the past, and we have this great, quick, and aggressive policy response that further complicates inferring from past data what the impact of COVID-19 will be on the residential real estate market. So what we did with my colleagues, I don't want to bore you with too many technical details, but we essentially think about it as a big statistical, big data exercise. We have essentially very detailed data on every single loan in the U.S., tracked for more than a decade. We have actually almost 2 decades of data. And we take advantage of the fact that historically in the U.S., there's a lot of heterogeneity across regions. You have regions when house prices go up and there is unemployment, places when have a lot of unemployment but not as big drops in house prices. Of course, all these things are endogenous, so you have to be careful about inferring something about the statistical associations from the past, but it's essentially kind of a big data statistical model that allows us to make predictions based on the historical performance of borrowers in various regions. One thing I want to importantly stress, it corrects and controls for the fact that the risk of the market, the risk of the debt market is changing. So even the same shock in 2007 will have very different impact in 2020 because the nature of borrowers' leverage is very different now than it was in the past. So I just first want to show you some quick simulations on this. And again, remember, we have done it, we adapted essentially some framework which we've already developed for these scenarios. We did it partly to show it to some people in policy circles. We assume initially that was done in March and early April that, the recovery will take by 2021. And these are various scenarios in terms of how unemployment will evolve. And we do 2 types of scenarios. One, when we assume house prices don't change, and another one, this is, by the way, the unemployment during the Great Recession, and another one when house prices change. These big red dots show you where we were in the second and first month of pandemic. So by about third month of pandemic, the unemployment was about already 15%. Now it has trended downwards somewhat, and house prices has, if anything, moderately softened nationally. In some areas, they went up. In some areas, they went down. So the first thing we did, I'll first show you a bunch of predictions which we have done keeping the house prices constant. And essentially we find out that the delinquency level, the serious delinquency is about 2 to 8% of the total mortgages. If you translate it into foreclosures, we'll have about, if unemployment recovers reasonably quickly, we'll have about 1% of loans going into foreclosure. In the U.S., there's about 55 million borrowers. So you talk about 500 to 600,000 foreclosures, unless, of course, there will be a very big increase in unemployment, and then you can push foreclosures to more than 1 million. Now, of course, there's a critical role of house prices. If house prices substantially decline, this gets much worse. We'll have about 14% of households missing payments on their mortgage for a prolonged period of time. And of that these houses, about half will go into foreclosure, a little bit less than half. So we'll end up with 6% foreclosure level, a little bit higher than 6%, which actually pushes us close to 4 million foreclosures. But for this scenario to happen, you would have to have a big increase in unemployment and significant deterioration in house price conditions. Note that this is still better than Great Recession. Why this is still better? Remember, Great Recession has 10% foreclosure rate and 6 million foreclosures as opposed to 4. It's better because of two reasons. We assume that recovery will happen by the end of 2021. In fact, if recovery takes longer, this effects will be more pronounced. And second, the quality of loans was much better in 2020 than in 2007. So in other words, the housing market was not as risky in 2020 as it was in 2007. So the bottom line, one thing I want you to keep in mind from this simulation, that as long as we have recovery within the next 2 years, it's not going to be on the residential mortgage market side as bad as Great Recession, unless house prices decline substantially. But even then, we're going to get to about 2/3 of severity of Great Recession. And losses in this case will be up to $250 billion. So now let me show you what actually happened in the residential housing market. And I will first I'll first go through my slide, and I'll look for questions you have. So first of all, there was first, if you look on contraction of U.S. GDP, it was really unprecedented. The U.S. GDP in second quarter of 2020 contracted by about 1/3. If you compare it to Great Recession, this is really unprecedented. There is an undergoing recovery of employment, but we're still at a very high unemployment level than before. But there is some signs, of course, as you can see on this picture, that we are recovering. If you look on recovery of consumption, there has been recovery that has recently stalled. You can see that in June, July, their consumption stopped growing up. And of course, big question, what's going to happen going forward? Remember that $600 unemployment support has expired. We have Trump executive order that replaces it with up to $400 per person. But it's not clear whether it will be implemented and how quickly. So if this issue is not addressed, we might actually expect drop in consumption going forward, which could, of course, adversely affect real estate. So what happens are investors worried about it? Remember, the markets are forward-looking. It seems they are not really as worried because as of yesterday, Dow Jones Industrial Average has been only about 2.7% down relative to the beginning of the year. Of course, some of that could be pricing expected inflation, monetary stimulus. But nevertheless, remember, markets are forward-looking. And you can see there has been a significant recovery of stock prices from the kind of bottom around the late March, beginning of April. And comparing this to Great Recession, remember, during Great Recession, it took about 5 years for the stock market to kind of get to the pre-crisis level. Here, it really achieved that in a matter of about 3-4 months, almost. So what happens in the housing finance market? The key thing is the forecast regarding the house prices. So far, house prices has not really declined substantially. Some companies like CoreLogic forecast about 6% decline by May 2021. But again, coming back to the policy response, the full effect would really depend on what's going to happen in terms of stimulus going forward and how quickly the unemployment will recover. One silver lining of this massive stimulus measures that were implemented, the mortgage rates are now at historical low. You can get a 30-year fixed rate mortgage for as low as 2.88%. And if you get good credit, you can get even lower rates. And because of that, remember, interest payments on your mortgages are also tax deductible. So the effective cost is, for some high-paying taxpayers, half of that amount per year. So this really helps in two ways. First, it makes housing much more affordable, which helps with the housing demand. And second, it stimulated a huge refinancing boom. In fact, if you look on the amount of households that could benefit from refinancing, if rates are 2.87, we can have 20 million of households that would benefit from this refinancing wave. That means these households after refinancing will have more money in their pockets, and households have significant housing equity to tap. So this is positive news for the housing market. If you look on recovery of home sales, you can see that in March, April, there's a big drop. This is largely because of the shutdown and essentially the real estate brokerage markets collapsed at this point. But you can see a very robust recovery, and new pending sales are most important indicator. It's a lead indicator because, as you know, it takes some time to close your home purchase. And I think many economists, including myself to some extent, were surprised by the current state of the housing market on the positive. And in fact, there's a bunch of things going on here. First, market in many places, the housing market is somewhat supply constrained. There was not as much of a development boom over the last few years. And we have millennial generation that postpone home ownership. And now because of these lower rates, they're really flocking into buying, provided they have a stable job and they can afford it. So if you look on these indicators, the housing market so far is doing really remarkably well. If you look on delinquency rate, it was close to historical low at the beginning of the pandemic. You might think, okay, this is all good, but this masks one important factor. If you add forbearance, a significant share of loans on the residential side are currently in forbearance, taking advantage of the CARES Act provision. So if you take forbearance, we have almost between 7.5% and 8% of loans that are effectively in forbearance right now. And of this law, this is how they are concentrated in US. The redder the area, the more stressed borrowers are in terms of taking advantage of missing payments on their loans. And of these people in forbearance, only about 20% make payments, about 80% of them don't. And if you look on maturity, some of these folks that got forbearance already get another extension. There is an important wall of maturities on this forbearance in September. So from the policy response, we'll have more than 2 million of borrowers that by the end of September, their forbearance will expire. And there's a very big question mark. What's going to happen to these borrowers? Are they going to resume making payments, or are they going to default on their loans? And just few policy ideas what to do. A number of people, including myself, think it will be sensible to roll the missed payments. Remember, the forbearance is not debt forgiveness. You essentially defer repayments of your principal and interest rate. It would seem sensible to roll this principal and interest repayments into your principal balance. That would spread out repayments and avoid this adverse payment shock for these borrowers that could stress the housing market. We could also consider a variant of HARP program, essentially allow borrowers to refinance their loans regardless of the employment or housing equity status. And if by September of 2020 the situation is bad, say we have increasing unemployment, problems with people making these payments, we calculated that it will cost about $20 billion to support mortgage payments if the government would like to directly pay mortgages of households for a certain period of time. Of course, an extreme measure, you would have to think about potential adverse effects on incentives of households to repay their debts, but it's something that we should keep in mind. Now, let me move to the commercial real estate market. So what I want you to kind of remember from this discussion we had on residential, housing market is for a moment in a reasonable good shape. The big sort of question mark is how much unemployment will keep recovering and what will happen to the policy stimulus provided to those unemployed. If there is one area of significant risk is the sizable share of loans that are in forbearance and how this forbearance will be handled when this forbearance expires. Now let's go to commercial real estate market. So first, in the very beginning of pandemic, there's a very significant drop in the value of real estate equity. The best market to look on it is real estate equity, the real estate investment trust market, because these are holding companies holding portfolio of real estate assets. Because they are publicly traded, we have this good indicator of what market is thinking about commercial real estate going forward. And as you can see, the drop was very substantial, about a third of the value by March 19, 2020. Now, of course, you have to take into fact that this is not a loss of value of the properties because this is equity, so there is a leverage. But if you unlever, and secondly, you have to take into account that, of course, this impact varies by property type. Usually, you will expect in a typical downturn, things like hotels, retail to be particularly badly affected. I think pandemic exacerbates this impact because due to shutdowns and social isolation, the impact on these properties is more pronounced. So if you look on sector by sector, residential real estate lost about a third of the value as well as industrial and office, but retail and lodging by March 19, 2020 lost more than half of its value in terms of the real estate equities, and lodging lost about 2/3 of the values. Now, you have to unlever this effect, so the dark green shows you the impact by sector when we remove the leverage. So you should think about the dark green as telling you what the stock market was telling was the decline in the value of the properties. And you can see the biggest decline was in malls, 35%, lodging, hotels, 35%. But for example, data centers, industrial real estate did much better because, they are less impacted by COVID-19. And in some sense, some of these assets are doing better because in increasing demand for data processing, we're currently on Zoom call, and some of data center is processing our Zoom call at the moment. So what's interesting, if you think about what this prices tells us about the extent of the impact on commercial real estate, think about a typical property unlevered, which say you bought it on a multiple of 20 times cash flow. If you would just remove 1 year of cash flow, say all the pandemic means there's going to be no cash flow for 1 year, we would expect a drop of value of about 5%. These drops are much bigger than that, which tells you, of course, anybody who understands asset pricing knows it's a combination of dividends, cash flows, and changes in discount factors. But this drops in prices definitely prices a much more prolonged recession and potentially also significant increase in risk than just 6 months or 1 year drop in rent collection, even drop to rent collection to zero. Now, of course, there was a partial recovery. After CARES Act was passed, various stimulus measures were implemented, and we get a better understanding of pandemic and its effects. Residential real estate right now is down about 20%. Office and industrial is down about 10% relative to the beginning of the market. But as you can see at the bottom two pictures, retail and lodging hasn't really recovered. They recovered partially, but hotels in particular are still very adversely affected. This is really the asset class that's suffering the most on the commercial real estate side, followed by retail assets. And it's not very surprising the hotels have suffered tremendously. You can see the very, very pronounced decline in revenue per available room. For some hotels, it was a decline of up to minus 100%, essentially no income. And this is very persistent. There hasn't been as much recovery in that. Of course, in some areas, hotels reopened, but the situation is really pretty bad on the hotel space. Obviously, I'm sure for those of you from New York, you are familiar with this, that some four-star hotels in New York are currently acting as homeless shelters. It just tells you that from the perspective of the owners of this, which used to be well-performing assets in Manhattan, it's now a good deal to get money from government by hosting homeless people as opposed to try to, survive pandemic and reopen these hotels later on. It just shows you how bad really the situation for hotels is. And New York City already had a lot of problems with hotels because of the overbuilding prior to pandemic and drop in the foreign demand and Airbnb. But that just pandemic is really a very, very significant blow to this asset space. On the retail side, this is just retail bankruptcies and closures we had by month in 2020. In May, we should say kind of bye-bye to J. Crew, JC Penney. In July, we have a number of other brands that went down. Think about Brooks Brothers and others. And because of that, of course, the retail is suffering. If you look on rent collection, this is from the Real Estate Investment Trust Research. So keep in mind, this is kind of geared towards better quality properties. You see the rent collection is actually still quite good in most of the asset classes, except, of course, hotels, which are not shown here. The hotels don't have long-term leases. Hotels are doing horribly. And another asset class that does pretty bad is shopping centers, but there was a recovery. In May, the shopping centers on average collected about 49% of their rent. By July was close to 70%. If you look on real estate debt values, there's a significant decline in debt values. This is CMBX's triple B that kind of has some good exposure to the lodging. There was increase in the spreads, which essentially is a proxy for the cost of credit if you want to refinance or get a new loan. And more important, if you look on commercial mortgage-backed security market, when we have a good data on performance of commercial, on debt financing commercial real estate properties, you see there was a very big increase in delinquency rate following the pandemic. There's a slight decline in July 2020, but these are the levels which are very close to Great Recession levels. And who is defaulting the most? It's hotels and retail. About a quarter of hotel loans sold through commercial mortgage-backed securities are currently in default. So this is a very, very sizable number. So not only hotels are performing very poorly on the income side, but also hotel operators are really in mass of stop paying their loans, and a lot of these hotels are going already in very significant distress. If you generally see in U.S. where these delinquencies on commercial real estate loans are located, you can see Northwest Central areas particularly badly hit, some areas of Southeast Central, but in many other places the delinquencies are reaching 10, 11, 12%. Of course, these delinquencies are a benefit for some folks. Blackstone, on one hand, has recently planning to shut down the commercial mortgage-backed security fund. They lost 24% of the value. They were long on commercial mortgages from the time before pandemic. On the other hand, you have companies like KKR that raised recently significant funds to actually invest in this and buy these distressed mortgages and distressed properties, viewing it as a one in the lifetime opportunity to buy distressed assets. And there's a significant discussion of commercial real estate debt bailout. It's really championed by Texas Republican Nick Van Taylor. And there's some discussion in Congress about potential bailout of providing some lifeline loans to operators of commercial real estate assets. So, if you're a KKR and you buy this distressed real estate debt and then there is a potential bailout, you might actually benefit from that. So I'll look at a bunch of questions you have, but let me sort of wrap up with some sort of a longer term impact of commercial real estate. So on the lodging side, the impact is really bad right now. A quarter of hotel loans in CMBs are in default. The revenue drops are horrific in many places. And the general belief is this impact will be very persistent. It takes time also to affect people's belief. My colleague and her co-author, Laura Belkan, has a really nice paper on showing how, your beliefs can be affected in persistent way. And, even if pandemic alleviates, it's not like everybody will immediately flock and stay in hotels unless we have vaccine and unless we're really certain that, the risk is really low. So a lot of thinking in the industry right now is how to reposition hotels. So if someone on your calls are, in real estate distress, work for opportunity funds, this is kind of the number one asset you'll be looking at, buying a hotel and maybe thinking to even operate it cheaply or convert it into something else, maybe convert it in the homeless shelter or convert it into office, convert it into maybe multifamily. So the lodging is one place that I think will be hurting for a prolonged period of time. Retail. Same story to a large extent is about retail. If anything, the pandemic just accelerated e-commerce trends. We know that a larger and larger proportion of consumer activity is moving online. And I think the specific places that will be more exposed to this will do substantially worse. It doesn't mean that some experiential retail, high quality retail won't come back. I think we still enjoy going to stores, so not everything can be bought online as seamlessly. So, but I would personally expect a prolonged impact on retail, and in some sense, you saw the tremendous amount of closings and bankruptcies of retailers suggest, this asset class will be hurting going forward. Office, the impact is more interesting. So if you talk to office operators, the one concern is, telecommuting can move to suburbs. If working by Zoom means that, a large share of the workforce will be able to work from home. And if they will be able to work from home, of course, that means less demand for space. In addition, maybe suburban office will be likely winner since people will maybe be more likely to live in suburbs. Maybe office will move closer to where they live, and suburban office that allow social distancing at much cheaper cost might be the kind of a winner in that sense, if you believe in this, the commercial office space in big cities like Manhattan will be in trouble. To the extent, this shift full to suburbs would not materialize, the impact of the pandemic on office is kind of ambiguous. Let me tell you what I mean. So the office trend over the last 3 decades was to lower the square footage per person. So typical person in office in 1970 consumed about 600 square foot. By 2017, it was about 150. Part of that is co-working, companies like WeWork. Part of it is more open spaces. Also removing need of storing a lot of documents. So the pandemic will have kind of two effects. On one hand, if people move to suburbs or are more likely to work from home, you don't need office space. On the other hand, if you want to keep people in office space, you may want to socially distance them better. In particular, some regulation might require you to do it. So conditional on still needing an office space, you might actually need more office space per worker. In that sense, some, for example, prime office spaces might benefit from that because suddenly the company that used to house X amount of workers per square foot might need more space to house the same amount of workers. One area which I think impact is obviously quite adverse is co-working. Think about companies like WeWork. They're really in trouble because, the whole concept of WeWork means packing a lot of people per square footage, as many as you can, and obviously pandemic, social distancing, and associated regulation are not helping you in this regard. Now, so we don't exactly know which way it will evolve, but I think there's going to be, the impact will be quite interesting, and some properties actually might do quite well while others will not, and it depends on whether there will be demand in central business district area for this office or not. If you think about multifamily, there are kind of bunch of trends here. One is the potential move to suburbs. That will be a very big bad news for the multifamily in cities like New York, San Francisco, Seattle, Portland. Potentially good move for multifamily buildings which are reasonably not too dense in the suburbs. And of course, there's a big debate right now about viability in future of cities. It's all superimposed by things like recent increase in crime, concerns about high taxation in cities. If you look what's going on in New York City right now, there has been significant increase, especially in Manhattan and Brooklyn, in available rental inventory. This sort of ties to this, what people call the flight of people from New York City. A significant share of folks have moved out. Some of them moved out to second homes. But many of them actually move out without renewing their leases. So in that sense, there's a big question mark how cities like New York will perform. I think it depends a lot on the quality of the, guidance and policy making coming from mayor's office and so on. And, certainly there's a lot of discussion about it right now. Industrial, I think industrial will have a limited impact unless, of course, we have a prolonged Great Recession. If anything, it could be positive for some asset classes like data centers, warehouses that help e-commerce operate. And then kind of the last thing I want to say is there's also this ongoing real estate tech revolution. And I think in some sense, the pandemic will accelerate certain trends, digitization, online showings of apartments, online brokerages, ability to rent, buy real estate by clicking a mouse, things like that will become more prominent going forward. So let me have a quick look on questions you have. So kind of let me leave you with kind of the summary of where we are. What's going to happen critically depends on sort of the evolution of pandemic, but also very critically depends on how the policy making will evolve going forward. Currently, the residential market is doing reasonably fine. One area of concern is a very relatively high level of forbearances and how they will be processed by the system when they expire. On the commercial real estate side, the biggest impact are hotels and retail. Hotels in particular are really in a bad shape, a large increase in delinquencies. Many of these hotels might not be viable going forward. Now, of course, it's also superimposed on geopolitical trends, decline in foreign travel, various visa restrictions, and so on and so forth. On the office, the impact is kind of more ambiguous. Multifamily, depends where you are. Industrial, I would view, and limited impact. In fact, industrial might also benefit from some reshoring of activities to U.S. So Let me kind of stop here. I'll quickly have a look on a bunch of questions you have through the Q&A. And we talked, so when one question is on multifamily post-COVID, as more people are moving to suburbs, I've already kind of touched upon it. It's a big, really question mark. I think there's no doubt that in the near term, places like New York City will suffer. I've actually tracked rents in Manhattan, and I have additional ways to see maybe things before they are reported by companies like Street Easy, and I saw 6 to 10% declines in rent. On some luxury buildings, you see 15 to 20% declines in some places. So that's certainly, and the picture that actually is currently that you see definitely shows that this impact can be quite pronounced. Yeah, the question is about essentially, I think we discussed about why housing hasn't crashed during the current pandemic. As I said, very aggressive policy response, but also on supply side. The housing supply was somewhat constrained, and we have this millennial generation and some folks with delayed home ownership, childbearing, household formations that are interesting to buy right now. And rock bottom interest rates help currently cushion housing market. And some say over-leveraging CMBS mortgages were reason for Great Recession. Do you think CMBS in residential is in trouble even this time, or is it strong right now? To Sanil, as a question from Sanil, the CMB, the commercial mortgage-backed security market was not really the cause of the Great Recession. It was more mortgage-backed security market on the residential side, in particularly mortgages originated by companies like Bear Stearns, Lehman Brothers, originated and underwritten, that were not guaranteed by government. We don't have this market really right now. This market collapsed and never really recovered in any meaningful way. So that's part of the reason why housing market is in a reasonably better shape right now, because of the most of the mortgages are guaranteed by government. The rest is kind of jumbo, and they are just in a better credit position, have more housing equity built up by 2020 than the loans that were in 2007. So in other words, the projections I show you didn't have as big of an impact of the unemployment on defaults, and of course unemployment is the key driver of mortgage defaults, precisely because a lot of borrowers have reasonable equity cushions, reasonable financial position to not immediately default and go into foreclosure following unemployment. It's very increased demand for build for rent is very movement to suburbs. We do see movement to suburbs. You can see it in a bunch of ways. One is tracking folks. The cell phone companies allow you to see people where they spend time, and by some estimates, about more than 400,000 people left Manhattan. Quite few of them are people that have second homes, so they didn't abandon yet Manhattan as a concept. The apartment is empty, especially if they own it. But there's increasing evidence that people are moving permanently. You know, the permanent change of address, changes of your address for tax residency. Do we think comparison of the stock market, Great Recession to current one is really justified? It's a very good question. Of course, the underlying holdings are different. More important, the underlying shock is different. Great Recession has a very different fundamental causes than COVID pandemic. So part of a reason why the stock market recovered much faster could be that we essentially have, we expect pandemic to be a relatively short-term thing. Changes in demand. So this is what I just discussed about office. There was a question of what happens online shopping. So we kind of already addressed that. Regarding refinancing piece, while set to be held, it must adversely impact banks, investor. How should we think about those dynamics 5 to 10 years? Excellent point. Of course, when you refinance loans, on one hand, the new loans will have lower yields. I would say it would affect mortgage-backed security investors, but these are mainly retirees, pension funds, which in some sense, in terms of a distributional impact, you help people which might have really liquidity need. You harm a bit people that might have a bigger liquidity cushions. So usually from the economy-wide perspective, if refinancing allows money get to people that maybe have higher marginal propensity to spend, it's taking away from some retirees, wealthier individuals, which have lower propensity to spend. So this kind of a redistribution of money from pensioners towards younger households could actually have positive impact on the economy. In addition, you might avoid costly foreclosures. Senior living sector, great point. This sector has been quite badly affected because of the social distancing needs. I talked to some developers, and there's a lot of thinking on redeveloping or developing new senior livings that essentially have greater social distancing. Of course, that would potentially increase the cost of these units, which, given issues with how much money retirees will have to spend, is a big question mark. There was again a question of new normal reality of working from home, how it impacts office and real estate space. So we kind of already discussed it. There was a question whether hotels should repurpose certain percentage of those into small office spaces. That's a great idea. In fact, some hotels are already doing that. And what's nice, a typical hotel room has a bathroom. So you can have a person working, turn essentially hotel room in the office, and you don't even have to share bathroom and so on. New York City market, we already discussed it. There was a question on impact. I think, New York City is an interesting market. It's very volatile in the sense it can bounce back pretty badly, but it also shown a significant ability to recover. Around 9/11, there was a talk about how bad it will be, and the market recovered. I think very important is what happens with increasing crime, with quality of services. The big problem for New York is, and it brings us back to the policy response, is, there's going to be a fiscal crisis looming for New York. Two reasons: increased spending for pandemic, unemployment, less people working, and flight of high-income taxpayers. I've heard that 1% of taxpayers in New York City account for, in New York State as well, account for about 50% of revenue. If these folks move to Florida or Texas, that will have a very significant impact on the ability of New York City to provide basic services. Then, of course, depends on policy response, depending on who wins the election in November. What do you believe is the most attractive segment? We touched upon it. Maybe the best thing you can buy right now is a distressed hotel at a really rock bottom prices. This is what KKR is doing on the debt side. They were buying recently some commercial mortgages at 30 cents on a dollar. So potentially that could be the great investments. There was a great question from Mark, just a student in my exec MBA class. Part of the reason the impact on commercial real estate is somewhat delayed because there are long-term leases. Of course, there's force majeure that has been debated to what extent these leases can be broken. So I think the big thing on commercial real estate will be in a few years when some of these leases expire. And you can imagine a big company deciding to not renew their lease in Manhattan. So right now, the rent collection is fine. What we should really track very carefully is rent renewal. And I think my question really touches on this. There's a question from Nathan. How you expect those to change the economy. So, of course, cap rates are affected by a bunch of things. Low rates tend to lower the cap rates and increase the values. On the other hand, we have increase in risk and drop in growth. And my general perception is the commercial real estate market would experience some decline in property values, potentially bigger than the housing sector. There's a question about big negative impact on the housing and insurance markets. We kind of discussed it. There's certainly concern that, if this forbearances translate into permanent delinquencies, we could be in trouble. I'm just looking for a bunch of questions. Let me take one or two, few more because I want to kind of finish on time. There's a question on repurposing, which we've already discussed. Yes, the demand of more space, could it be short-lived? Yes, for sure. But if what I was mentioning in my talk is, if the pandemic persists for a few years, there could be more demand for space, especially for prime companies who want to have presence in top markets. It depends also on regulatory response. It could be that there's impact on beliefs. Even if the pandemic gets over, we might have another pandemic, and people might just say, I need more space. I want my own bathroom. So again, I want to come back to this idea of persistence of beliefs. Even if, say, we have pandemic, maybe if workers that get more space would be against of being cramped up again. And they would say, look, sure, the pandemic is over, but we don't know, maybe it will recur. And plus, I really need more space. I really want to have more space to really work. And as a kind of a precautionary thing, even if this pandemic goes over, maybe we enter an area of this risk maybe is quite recurrent. So as a precautionary measure, companies might actually provision more space for workers. Do the foreclosure moratorium eviction impact long-term investment in housing at the lower end of the market? I think this is a great question from Ted. I'm quite concerned about this as well because both on multifamily, the concern is that as far as I know, on the multifamily for lower income households, the rent collection is much worse. There are considerable concerns whether you'll be able to collect this rent. And yes, Ted, to your point, I am also concerned about that folks might be unwilling to develop multifamily for lower income households, thinking that these forbearances, rent eviction moratoria might mean lower cash flow collections if crises occur or persist. So that could have an impact. How will Treasury being so low affect real estate? So the obvious thing, they affect real estate for the value of real estate properties because they have negative impact on cap rates. And they also help refinance and finance real estate properties at much lower level. So for example, if you're an operator of real estate and Treasury rates are lower, you can now refinance it at a much lower cost. Of course, the cost is higher because of the pandemic, but that cost would be even higher if Treasury rates were not so low. So let me just take a couple of more questions. There's a bunch of questions on affordable real estate. What alternatives then are for the retail shopping mall space? One obvious alternative is to convert them in warehouses. So think Amazon taking retail shopping mall and converting it into essentially a warehouse, another warehouse. Other alternatives, you could think about converting some of them in office spaces, some sort of social areas. You can make a big gym with a lot of socially distant space, healthcare places, and so on. If you look at any parameters that indicate future office vacancy rate, I did look on some lead indicators. So first of all, the rent collection, of course, is low on the retail side. There's a very big string of bankruptcies and retail closings, so that will have adverse impact. On the office space, rent collection is fine. Some indicators suggest some drop in the renewal of leases, but it's kind of too early to say. Listen, thanks so much to all of you for a great participation and all your questions. I really appreciate it having an opportunity to present to you. Especially, I want to give a warm welcome to all the alumni and current students that are on during this webinar, my colleagues also from Columbia Business School. Again, I wish all of us all the best, and hopefully we'll have a quick recovery, including in New York City. And just in the interest of time, let me finish this webinar. And if you have any questions or you want to get in touch, feel free to reach me out by email. Anyway, please stay safe and have a nice day.